Hey, my name is Thomas Castelli. I'm a CPA and certified financial planner with Hall CPA. We're a firm that exclusively works with real estate investors. And today I'm going to talk about real estate accounting and tax for real estate investors. So what are the most common mistakes real estate investors make? Well, I see a lot of investors, the biggest one is that they're not working with a real estate tax or accounting specialist. They're working with a generalist. And the thing about real estate is it's one of the most complicated areas of the tax code, and there's a lot of nuances. And generalists typically do a lot across a broad area, never really drill down. And what ends up happening is they end up costing their clients a ton of money in lost tax savings or missed opportunities because they're not aware of everything that is available for their clients. So that's one of the things I see. Another thing I see is the actual investors themselves don't keep good books and records, right? So they might be working with a property manager, and the property manager has property management level financial statements for the property, but it's not quite in the type of format that you'll need to make good financial decisions for your business, or file your taxes come tax time. And there's just a tremendous amount of work that has to go into actually cleaning that all up. And if you were to do that throughout the year rather than just waiting till the end, it becomes a lot easier for all parties involved. So it's just another area. Some other areas kind of going along those same lines is some people just don't document anything. And it's just, they don't document mileage they drive for their business. They don't document any meals that they have with business associates. They're not properly documenting travel. They're not keeping organized records. So documentation is absolutely critical in any business, especially real estate, when you're dealing with such complex tax strategies. The last one I'll say is that they never actually find or receive tax planning or tax advice from anybody, whether it be their CPA or financial planner, on what they can do to actually minimize their taxes, right? So there's a difference between tax preparation, where someone's filing your tax returns for you, and tax strategy and planning, where someone's actually sitting down with you and looking at your situation saying, okay, well, here's where you are today. Here's where you're looking to go. Here's the moves you can make, the strategies that you can implement that's actually going to help you reduce your taxes when it comes time to file the tax return. So those are just a handful of mistakes I see that are constantly made. All right, so what are some things that journalists may not be aware of that real estate investors can use to actually minimize taxes? Well, there's a lot, but I'm going to break it down here. So the first one's the real estate professional status, probably the most coveted tax status in the entire tax code, because it allows long-term rental investors to take losses from their rental properties and use them to offset their active income, such as income from a job or an active business you may be running, and that can be quite powerful. A lot of CPAs either aren't aware of this or just get it completely wrong. And for something that is as powerful and also highly litigated, it's important to get this right. So real estate professional status, one of the top things for real estate investors. The next thing is going to be cost segregation studies. And cost segregation studies is when someone basically breaks down the various components of a property and allows you to accelerate your depreciation expense, which is a non-cash expense that reduces income for tax purposes, but not actually your cash flow. So in other words, it's the money doesn't actually leave your pocket, it's only on paper. And this can actually create a really big tax loss for you that if you're a real estate professional, you're able to use against your other income. All right, so that's quite powerful. Another thing out there is what's become known as the short-term rental loophole or the short-term rental exception. And that is that under the Tax Reform Act of 1986, all rental activities were made passive by default. However, if you have a rental property with an average stay of 7 days or less, it's not considered a quote-unquote rental activity. It's just considered a normal business at that point, and it's not passive by default. And if you get actively involved, if you materially participate, the losses from your short-term rental property can be non-passive and offset your other income. And when you combine that with a cost segregation study, it becomes just as powerful as the real estate professional status. So those are a few things. Some other strategies that are out there for real estate investors include the 1031 exchange. That's your ability to defer taxes upon an exit or a sale of a property, and basically take the sales proceeds and trade it up to usually a larger property, and continue to grow your wealth and continue to just kind of kick the can down the road. So another one's a partial asset disposition, and this is a little known strategy that no one really ever talks about because it's kind of boring. But basically the way a partial asset disposition works is that it allows you to fully deduct the value of a certain component of your property in the year it's replaced. The best example I can give of this is probably a roof, right? So you buy a property, there's a roof on it, hopefully, and let's just say you have to replace that roof. Well, that original roof is going to be depreciated on your depreciation schedule over 27 and a half years if you have a residential property. And when you replace the roof or put the new roof on, what's going to happen is that new roof's also going to be depreciated over 27 and a half years. So now you're depreciating the old roof and the new roof. Well, the partial asset disposition allows you to deduct the entire value of that old roof in that year that it's replaced. And that is an expense that will come out on your P&L and could create more losses for you that you could use to offset your other income or shelter your rental income from tax, making it quite powerful. So Jason from Arizona asked, about the real estate professional status. How does it work? Because he just started investing in short-term rentals. So there's kind of two things going on here. So the first thing I'll say is that the real estate professional status applies mainly to long-term rental properties. And to give the definition of a long-term rental property, it's going to be a property that has an average stay of 8 days or more. So most rental properties out there. And the real estate professional status will help you use the losses from these long-term rental properties against or to offset or reduce the amount of income that you're paying in other areas. So in order to qualify as a real estate professional, you need to spend more than 750 hours in a real property trader business and more than half of your total working time. So that last piece, that 50% of your total working time, often throws most people off and prevents them from qualifying as a real estate professional and taking the losses against their active W-2 or business income. And that's where short-term rentals have become so popular. So if you're using a short-term rental and it has an average stay of 7 days or less, it's going to be removed from the definition of a rental activity, and you won't need to qualify as a real estate professional to take the losses as non-passive and reduce the amount of taxes you're paying on your other sources of income, such as income from a job or an active business. If your short-term rental has an average stay of 7 days or less, it is accepted from the definition of a rental activity. You don't need to qualify as a real estate professional in order to use the losses from your short-term rental to reduce the amount of tax you're going to pay on your active sources of income, such as, say, income from a job or income from a business. All you have to do is materially participate in your short-term rental, and that can be done by meeting one of 7 tests. However, there's 3 tests that really matter to most investors, and that's going to be either A, you do substantially everything yourself, which means you're a one-person show and you manage the property yourself. You do pretty much everything A to Z. The next test that you can meet is that you spend more than 100 hours on your short-term rental property, and no one else spends more time than you. So you spend that more than 100 hours, and no one spends more time than you. The third one is you spend more than 500 hours on your short-term rental. And if you do those 2 things, average stay of 7 days or less, and meet one of those tests I just mentioned, your losses will be able to be used against those other sources of income I mentioned without having to qualify for a real estate professional. So kind of sum that up right there. Real estate professional for long-term rental properties and for people who could spend more than half of their total working time in a real property trader business. If you can't do that, then the short-term rental loophole will be the next best thing for you. And that's when you have an average stay of 7 days or less on your rental property and you materially participate. All right, so what are some real-world examples of how this stuff actually works? So I've worked with dozens and dozens of clients, and I've seen these principles work day in and day out for so many people. So let's just say, for example, you had a $500,000 property, kind of middle of the road, nothing too crazy. Well, if you were able to use a cost segregation study on this property, you could generally expect somewhere between 20 to 30% of that to be reallocated to 5, 7, and 15-year property, which is eligible for 100% bonus depreciation. So let's just say you were able to get a $120,000 expense from this property, depreciation expense. And remember, depreciation is non-cash, so it doesn't actually reduce the amount of income that you're earning or your cash flow. It only reduces the amount of income you have on paper. So say you were able to take this $120,000 loss as non-passive against your, let's just say your W-2 or your active business income because you qualified as a real estate professional or use the short-term rental loophole. Well, this $120,000 would be worth to you if you're at, say, the 24% tax bracket. I'm just pulling up my calculator here so I could do a quick calculation for everybody. Well, this $120,000 expense would be worth $28,800 if you're at the 24% tax bracket. So that's pretty powerful. It's almost $30,000 in tax savings. Now, let's just say you're at the top tax bracket, 37%. Well, this $120,000 expense at the 37% tax bracket would be worth $44,400 in tax savings. That's powerful. That's a car. That's a down payment on another property in some cases. This is a real life scenario of combining the real estate professional status or the short-term rental loophole with cost segregation studies and bonus depreciation. And that's something you could expect to do if you execute these strategies properly. So this is another thing that real estate investors will want to know about, and that's called the de minimis safe harbor. And the de minimis safe harbor allows you to automatically expense anything, pretty much any expense with an invoice line item of $2,500 or $2,500 or less. And why would this be important? Well, let's say you buy an appliance, right? Say you buy a refrigerator, you buy that refrigerator for $1,700. Well, a refrigerator is typically going to be 5-year property, and it's going to be added to your depreciation schedule and then depreciated. And eventually, you're going to have to pay that depreciation back in what's known as depreciation recapture. And there's ways to mitigate depreciation recapture, but if you can avoid it altogether, then you're that much better off. And the good news is that expense, because it's under $2,500, it's only $1,700. You can use the de minimis safe harbor to expense it or to just take it as an expense in that year that you buy it. And you don't have to worry about depreciating it. You don't have to worry about depreciation recapture. And this is just a very common thing that people need to be aware of whenever you're purchasing supplies. Don't go and get an invoice that says kitchen rehab $25,000 because there's not that much detail in there, not much you could do with it. You have to capitalize and depreciate that. Instead, get it broken down by invoice line item so you take maximum advantage of the $2,500 de minimis safe harbor. That's all for today. My name is Thomas Castelli. I'm a CPA and certified financial planner with Hall CPA. We're a real estate accounting firm that exclusively works with real estate investors across the United States. We help them with tax preparation, tax planning, as well as accounting and CFO services. If you would like to learn more about any of that, you just go ahead and head over to www.therealestatecpa.com and you'll be able to find your way around there for now. And we also have a few things that you may be interested in. We have a short-term rental tax guide. You can go ahead and learn about that at therealestatecpa.com/str-guide, and you'll be able to find that. We also have a free Facebook group. It is the Tax Smart Investors Facebook group with nearly 14,000 members at this point, dozens of conversations taking place on how to reduce taxes right now. And you can find that at facebook.com/groups/taxsmartinvestors. And you can go in there and join in on the conversation. The last thing I will say is we have a podcast where we release a weekly episode on strategies that you can use to reduce taxes. And that's the Tax Smart Investors podcast. And that can be found on any podcast platform.